All right, guys, welcome back. This video, we're going to talk a little bit about OTE, which is optimal trade entry, and premium versus discount. It's OTE. So I'm not going to spend too much time on some of these sections because ICT does a really good job of explaining some of these things. So typically, when you're thinking about a market, right, we have premium and discount levels. So in an uptrend, do you think that smart money is going to be buying towards the premium end of a range? Well, most likely not. They're going to wait for some type of retracement. When the markets get too overextended, they're going to wait for a retracement back into a discount level before they reposition and possibly add into their positions. So the easiest way of using or determining what's premium versus discount is the Fibonacci retracement tool. So you can go into Trading View, open up the Fib retracement tool, and if you click on the settings, right, we have all the levels that I use. So I'm most interested in the point 0.5, which is equilibrium, the 0.618, which is considered optimal trade entry, 0.705, 0.79, and 1. And then negative zero point 0.5 and negative 1 can be our targets. So our measured targets. You can even have negative 1.5 in there if you really want it. So really you just have to determine what is the current trading range. And that comes just from eyeballing the charts and understanding, what's an impulse leg and what can be considered a retracement. All right. So we can just go through here and just find a few examples. So this a lot of this is subjective, and it honestly comes with a lot of back testing on your own, right? So here's something that's really interesting that you guys really should be looking into is when the markets have an impulse move away, right? What is going to be left behind at these discount levels, right? If the big players can only fill their positions right at certain prices before the markets displace, they're going to leave these gaps in the market, these fair value gaps at discount levels. So that's something I really studied for quite a while. Is when you see these impulse moves, many times right at OTE, they're going to leave a fair value gap. So if you study this one, right? So we have this low to this high. What is left at optimal trade entry? This buy side imbalance, is it not? All right. So, you know, you could have taken a long in here and maybe you took a loss. But as long as we're trading within a discount, right, and we have liquidity that's above us, as long as market structure is allowing us to possibly position long, right? This is very choppy price action. This would have been pretty difficult to trade. But we're still in a bullish market structure, right? So we have this breaker, and then we have this order block, and we have this impulse leg where they're retracing to the 79%. Maybe you're looking at this volume imbalance in here. But many times when the markets have impulse moves, right, we have all these gaps left behind at discount. All right. So another example in here, right? So we can split this range in half, right? If we measure, right, this top portion is going to be premium, and then below that, 50% below that is discount. So we have premium and then discount, right? we are not interested in going long until we see a deep retracement, right? Again, this fair value gap was left behind at discount prior to the run higher. So we have higher time frame optimal trade entries, and we also have lower time frame optimal trade entries and levels of premium versus discount. So if we see this swing, right? Maybe you see this swing on a 3-day pattern. So we have one day. This is Thursday, Friday, and then Monday. Right. So maybe you're seeing this swing as a place to enter long, right? It's still reaching into discount, right? It's leaving this volume imbalance somewhere around right. It's fully filled in once it hits 50%. So they left that volume imbalance open. They retraced into discount prior to going long. Okay. So you have this area of discount, sorry, premium inside of a daily level. All right. So many times you're going to see really nice retracements inside of a smaller range, right? On the daily, we have this low to this high. We retrace back to the 61%, and then we took off higher. But let's say if we wonder if I can find where we are in here. All right, so that was our daily level. I wonder if we actually did not get into this lower fair value gap, but we did provide this nice buy side imbalance, right? And then a retrace to fill it, tapping this order block. All right, so we can view this move as another fib retracement, right? And you're just using these extensions as targets, right? So you can measure this low to this high. When you're entering long in here, you want to put your stop below market structure and your target possibly above these highs, or just use the negative -0.5 fib extension. All right, so there are, numerous levels of premium and discount, right? It's just about how you're measuring the range. Even if you take this whole range, right? We have premium, anything above 50% is premium, anything below 50% is discount. And you can see how they're building in liquidity, right? They're taking them out of the market. They're buying it at discount, which is creating the swing low. When they get back up to premium, they're offloading their positions because they're not ready to take these highs yet. Retracing again, deep retrace, right? Buying it below discount, running it up, building in liquidity, sending it higher, boom, sell off again. So this whole time we're just trading within a range, generating liquidity, right? Stopping the liquidity out of the marketplace. Right? They're building in liquidity in here. They have liquidity in here. They think that we're gonna, break the range, and then it just collapses back into the range. Right? We take out this low, and then it's allowed to go higher. So a lot of this you can't just say, I think it's gonna break out. You have to manage your risk appropriately because you don't really know the timing of when this is gonna break out, right? You kind of just have to trade price action. Yeah, you have to just trade price action, the price action that's in place in front of you. So I'm always present in the market. So if we have swept liquidity and we've taken out a high and we've rejected, right, you just have to follow that order flow lower. Because once we're failing to get above that high, right, you have to switch narrative, maybe based on this 4-hour candle in here, and expecting that we've already taken liquidity and we're going to trade back down into discount. Right, and you are going to get trades wrong. Like there's just no way around it. So again, we have this nice run here, right? And you can see how they left it. They left this buy side imbalance at a discount, right? They go back, fill it in, and then send it higher. And it's the same on the when we're bearish, you should be expecting, right, that we have a specific range. It's going to retrace into optimal trade entry areas and trade lower. So there's opportunity in here to go short, right? About 100 pips. There's opportunities to go short within a bullish uptrend, right? So you're kind of battling with the forces that are in play, you know, buying it below discount or selling it at premium. So if you're shorting a short term premium, you have to be mindful that it's trading in a longer term discount, right? So every time we've touched into premium, it's sold off. So you might take a loss in here if you don't take profits near these lows, which holding from, you know, Thursday all the way to Monday, I don't like doing that. That's probably too long if it's not really moving a whole lot. In that 3-day time span, I'm usually finding a way to scalp in and out of the market, right? Because we have a nice run on liquidity one last time to fill in this fair value gap, take out this high, and then it's allowed to trade lower. Right. So within those premium levels, again, same concept. We have old inefficiencies being left at premiums. Right. We have this sell side imbalance. It's all above the 50% level of that measured swing from this high to this low. Right. We're going in, filling in, and almost look how perfect that level is. From this candle's low to this candle's high. It's almost too good to be true. Right. So we've taken out that liquidity and then allowed to trade lower. All right. So that other than that, this is going to be, a quick one. This is on part of your back testing and part of your analysis is going to come from going back through these charts, plotting or, training your eye, first of all, to see these swing points, right? Because we have short term swing points in here, right? Where we have people going short, but we have higher time frame going long, right? And you can measure this low to this high as well. And I'm sure that this retraced into a discount level. And then we have this impulse leg, right? So again, we have fair value gaps being left at premium levels. So this is a fair value gap, right, at a premium level. And we have a fair value gap here being left at a discount level. And this is kind of how you can figure out is my trade gonna trade lower? Well, if there's a fair value gap that's being left at a major discount level, well, you're not really gonna see it retrace only to the 50%. It might go lower. It all depends on the context of the market, right? Something like this, we have this swing low to this swing high right here, right? Well, the fair value gap that was left behind, or the buy side imbalance, is all the way down at the 61% level. So it's not just going to retrace to the 50 and then turn around. Like it might fill this whole thing in and then go. So this is kind of how I back test. I don't really like um, just back testing old data. I just like going in the charts, marking them up, and studying it. That way, when it forms real time, I have practiced enough to understand why it's retracing. Where do I want to enter short, and where do I place my stop losses? Right. Again, this fair value gap is being left at a premium level prior to breaking down. All right. So with that, guys, go into your charts, study these concepts, kind of understand where these fair value gaps are being left behind, and it's going to add a whole lot to your trading. Just knowing, all right, this is why it's retracing really deep to fill this fair value gap prior to running higher, and you can use this as your OTE discount level, right? So hopefully this was insightful. If you guys have any questions, just shoot them off in the chat.